Welcome to Larkin-Gowan Insights, accountancy and business advice for all, a series that gives you bite-sized tips and guidance on tax, funding, legislation, reforms and much more. With case studies, business advisory and sector specials and even interviews, our team of experts are committed to helping you navigate the world of accounting and finance with a variety of presenters from across our specialisms. So, let's get on with today's show.
Welcome to this special mini-series, Beyond the Barn, the Business of Farming. I'm your host, Laura Clayton, an Assistant Manager in the Farms and Rural Business team. In each episode, I invite a different guest to share their expertise on an array of different business topics that affect the farming and rural community. We cover tax, obviously, legal matters, succession, inheritance, and much more. We go behind the scenes of how we support our clients and hopefully give you some tips along the way. On today's episode, I'm joined by Laurie Hill, and we are going to be talking about business structures. Thank you for joining, Laurie. Please could you introduce yourself for us?
Thank you, Laura, for having me on today. As you said, my name's Laurie Hill. I'm a partner at Larkin-Gowan, and I specialise in our farms and rural business team, looking after a multitude of family and farms throughout East Anglia, sort of throughout Cambridgeshire, Norfolk and Suffolk, dealing with business structures as well as general day-to-day compliance and advisory work.
Thank you, Laurie. So if we cover some of the basics then, what are the most typical structures that we see?
So in farming, it varies and it will be very family dependent. So often we will tend to see the standard structures of a sole tradership where an individual farms on their own. We'd have a general partnership, which will largely be a number of family members working together. You would then have a company, which again is driven by shareholders who own the business. There are other alternatives of limited liability partnership, which you don't see too often within farming, but it is an option. Often you see professional service firms like ourselves operating as an LLP. And then lastly, that's probably possibly becoming a bit more popular with the changes that are happening in the sector, is that a limited partnership is where you'd have, in effect, it's similar to a general partnership, but there will be one or two, maybe three partners, subject to the number of partners in the business, who will have a limited liability within it. So there is extra registration requirements, but those are the main structures that we tend to see within our client base.
I agree with what you're saying about the limited partnership. I've not really come across that too much before, but all of a sudden in the last few months, a few more have been sort of popping up.
And I think it's there as a mechanism for additional protections for the next generation who may be coming in, or if someone wants to come in who has outside wealth, they want that protected. The sort of additional reporting requirements tends to come with, or narrative that sits on the company's house, but there's no actual detail, etc., that actually is publicised on there. It's more the fact that you have to register with company's house for those side of things, and you have to then have a separate partnership agreement for it. But ultimately, you need to have the structure for the business is family dependent, and every situation and family is different, as we both know.
Very true. And talking of protection, does each structure offer a different level of protection?
Yeah, so in effect, let's start with a sole tradership and a general partnership are largely the same with regards to risk and reward, almost, because you are in effect an unlimited liability business. Therefore, if something went wrong in your day-to-day operation, they could then come after the sole trader or partners within the partnership for wealth that sits outside of the business, subject to what has gone wrong. Often you would have that protected by the fact that you have insurances and public liabilities insurance in place, but if something went drastically awry, then something would potentially cause issues within the wider asset base. Whereas if you have a company, you are a limited liability. In essence, the shareholders, their liability is the value of the company. Sometimes there are ways that things can circumvent that, but it doesn't happen very often. So ultimately, there is a lot more protections with a company. Similar, a limited liability partnership does what it says on the tin, near enough. So it's the partnership version of a company. So thereby, your liability is limited to your value inside the partnership itself. Obviously, we've largely covered as to how that works with a limited partnership, that certain partners may be unlimited, whilst others may be limited.
I think with some of my clients in particular, some have now diversified the appeal of having that limited liability is higher than perhaps it was before when they were just a simple farm. Well, not simple, but operating one stream.
Yeah, no, I would agree that and this comes back to actually once you've chosen a farm business structure or a business structure, that isn't defined for the rest of the lifetime of that business. Things do change, and you have to be adaptive within that. That ultimately you can switch from one to another. Often it would be if people are wanting to limit their liability, or they're wishing to almost demerge or pull an element of trade or business out of a current business. I have had one client whereby they are a partnership with multiple trades. We've demerged them into two partnerships with the view that one of the partnerships in time will incorporate. Again, that's partly linked to succession planning, but also limited liability in how they operate. So we can then apply incorporation relief to move assets in from a partnership into a company. People tend to look at that as a potential option. You tend to see potentially in a life cycle that it could be a sole trader to a partnership when they bring an individual may operate on their own, bring their children into partnership, and then in future might transition to a company. It all is varied, and it's the classic case of it's never one size fits all.
And you mentioned the incorporation relief. And what other tax implications have we got with these structures?
So the tax implication wise, there's two separate elements to this. So with regards to income taxes, sole trader and general partnerships, general unincorporated partnership, which a lot of our clients are, you are taxed as an individual. Yes, as a sole trader, that is kind of expected, but as a partnership, each of the individual partners, they operate a commercial business with a view to a profit, but ultimately they're taxed as individuals at the standard rates of income tax at 20, 40 and 45. Whereas if you're a company, it's like having you and I are sitting here today, Laura and Laurie, and it's like having Laura and Laurie Limited sitting as a separate third party within our business arrangement, if that were to be the case. And it's having a separate entity that entity itself is taxed under corporate tax rates, which at the moment are based on almost going back to the old style of having a small rate, a marginal rate, and a main rate. So the small rate of 19% up to 50,000, a marginal rate between 50 and 250, and then a main rate which is 25% for profits over 250. There is differential there, and where you want to draw money out of a company, it either has to be via a salary or via a dividend, which obviously has tax implications on the individual. An LLP works in the same way as a general partnership, so individuals are taxed as the income arises in each particular tax year. Similarly, with a limited partnership, again, they follow the same model as a partnership. When it comes to sort of the capital gain side, a company itself, albeit it might make a capital gain, is still taxed at corporation tax rates. Whereas as an individual within a partnership, if there are disposals made within a particular tax year, there are reporting requirements on the individual, not necessarily on the partnership. The partnership still completes a tax return itself, but it's taxed on the individual. So if I had a land capital account and I sold 5 acres to a neighbour, I as the individual would pay the capital gains tax, not the business. Whereas as a company, the business pays its own tax bill.
So it really does vary across the board then.
Yes, and it's making sure you've got things in the right place and have the understanding as to, yes, you might own 80% of the shares in a company. However, it's the company's money. Yes, you own 80% of the shares, which has a value, but you've got to think about how you get the money out if it's sitting inside.
That is one of the most common things I see doing a set of accounts, that they don't realise that the money sat there, okay, it's in the bank, but it is not theirs to touch just by taking it out.
Yes, which is always an interesting discussion.
Yes,
with
very
a number
fun.
of clients, the differential between the partnership and the company and directors' loan accounts and tax, but we won't get stuck
No, it's a different conversation.
into section 455 nowadays.
And in terms of ownership and control, how does that vary for a company and a partnership if you've got multiple people?
So let's start with a company. So a company is owned and run. It's run by the directors, but is owned by the shareholders. So within a company, the shares will have voting rights attached. Some companies operate with different share classes. Some have voting rights, some don't. But for the sake of the example, let's say we have 100 shares, all have voting rights. And we have mum, dad, and 2 children. Ultimately, mum and dad will have, let's say 60%, and then each of the 2 children have 20% each. So that makes a nice round 100. So they have 60 shares, 20 shares, 20 shares. When I say 60, it's 30 shares each for mum and dad respectively. The voting rights will run with the number of shares. So in this example, mum and dad can make the majority of the decisions and run the company because they have the controlling shareholding between the two of them, i.e. controlling shareholding is 51% or above. So that allows them to make the decisions, whereas those with a 20% shareholding don't have any really significant influence, and the 2 children together wouldn't be able to outvote their parents in that scenario. Whereas flip that on its head and say there were 4 individual family members in partnership together, it all will be subject to what's written in the partnership agreement. So often it's written that every partner has 1 vote. In that scenario, with a four-person partnership, you could end up with a stalemate. So you tend to then rely on the fact there's usually a sub-clause which states that if there is a stalemate, the prevailing vote will come through from a senior partner, which is usually mum or dad, subject to how the makeup of the family is. So that tends to how it would operate within a partnership. We have seen in recent times that actually the voting rights in a partnership agreement can be amended because there is some wiggle room as to how you deal with this, and it can be based upon capital ownership, which is similar to how it would work in a company. So in that respect, mum and dad would still have influence over the partnership on that basis, on a capital basis. But there's also, as you talk through this, is that there's another level to consider: land capital. Let's say you and I are the children, and we're in partnership with mum and dad. The most of the land capital could be still with mum and dad, and we each own a little bit here and there. If a decision was to be taken in respect of land that you owned, Laura, the ultimate decision would be yours because it's your land capital. So sometimes the voting rights they differ when it comes to certain decisions, but that's a fairly usual scenario that we tend to end up in when it comes to partnership agreements and decision making within partners or partnerships and with companies.
So again, both quite different, which emphasises the point that having these conversations about structures before setting these up are actually quite important because it could have a big effect.
And as you know, we get asked fairly regularly to review partnership agreements, don't we?
Exactly.
So that's something that we can wade in on and that's where our value adds and where our advice comes in to assess it, not only for tax purposes but also for commerciality and how things would actually operate in practice. And I think clients really value that from having your lawyer and accountant work closely,
making sure everyone's on the same page and understanding what's going on.
Agreed.
For these structures, are the admin and reporting requirements quite different?
So they are quite different with regards to the reporting requirements. The administration of the businesses is reasonably similar. The fact that you would run it on an accounting software and you'd either have quarterly or monthly VAT returns. But the reporting side of things for a company, so a company can have any year end that it wishes. And the reporting side of things is the fact that you have to prepare an annual set of accounts, which has to be completed and submitted to the revenue within 9 months of the year end. So in effect, 31st of December year end, you've got to submit it by the end of September. And that's similar with regards to when tax payments will be made for a company. A company has to pay its tax bill 9 months and 1 day after the year end, albeit there's an oddity there that actually you don't have to submit your CT 600 company tax return for 12 months post year end, so you have to pay before you have to submit it in theory, albeit we tend to try and submit ours alongside one another. So that tends to be the reporting requirements, as well as a company outside of the day-to-day accounting. There is obviously the annual confirmation statement, which is required for a company every year, and that is there to confirm effectively the ownership and the directors, the persons with significant control, amongst other things. So that's something to consider. And there's other things coming down the line, as you well know, with what is going to have to be reported for small companies and micro companies. So
Yeah, some changes are on the horizon for that.
So I can name a few clients who don't wish to have their profit and loss report as a small company on the public record. However, that is set to change, I believe, from April 2027. So that's another matter to cover on another podcast, I think.
I think so. Series 2.
And the other, obviously, the other bit is a partnership or a sole trader. Again, they're similar to an LLP or an LP. Is that you are, again, coming back to the point, is you are taxed as an individual. So therefore, having gone through basis period reform, you effectively now have to report on a tax year basis to effectively the 31st of March / 5th of April, which in effect for tax purposes are treated as the same date. So a lot of our clients report through to 31st of March. We will prepare a set of sole trader accounts or partnership accounts or LLP or LP accounts, whatever they may be for the particular family. And then the income is reported on individuals' tax returns, of which obviously tax is paid the 31st of January following the end of the year end. So you have that the extra month by comparison to a company. But for those who sit within the self-assessment regime, you would have likely also made a payment back in July as a payment on account towards your tax bill, which subject to investment in new kit each year with capital allowances, your payments on account could vary significantly within the space of 18 to 36 months, subject to what your investment policy may be.
I think traditionally as well, I think reporting requirements were before a bit more simple for sole traders and partnerships, but with the MTD basis reform and now MTD ITSA on the horizon, I think it's not as simple as it used to be.
I would agree with that wholeheartedly.
And that used to be quite an advantage or a reason to sort of pick those structures because they wanted the simple reporting requirements.
And I think with the making tax digital for income tax that is coming down the line more so, or quickly I should say, for sole traders and landlords, we haven't yet got a definitive date as to when that's going to be applicable for effectively general partnerships. So what ones we've discussed, as well as LLPs and LP partners in limited partnerships. But it's something that they had earmarked, or someone talked about 28 or 29. But again, we can't say anything definitively. But in effect, it's what it says on the tin: quarterly reporting with a final submission. So it will speed up tax payments, which people might not be overly keen on, but it's going to be forced upon us.
Yeah, so we have got to make sure we're ready when that time comes. And I know that I've been working quite closely with some of my clients to sort of just get them prepared for that. And we've obviously got our digital team ready for when the time does come to and waiting the guidance.
What type of questions have your clients been asking you?
Why is it happening? Do I have to do it? They don't like the idea that they have to give as much information. So they're trying to understand what HMRC want to see. So yeah, I think it's difficult because it is quite a scary change and it's quite a big change from what they were doing before, especially when you think of some of my old clients were, 10 years ago just writing up cash books. They can't do that now. So there's been a lot of changes for them and they are getting older. So it's just understanding why.
And that's the difficult piece, that often it's these sorts of decisions are top-down decisions made by HMRC, and they don't often think about the ramifications. I think it's very different in farming because we have farmers averaging, which is again another quite sizable topic,
Yeah.
Which is probably outside of business structures to consider. But ultimately, where you've got quarterly reporting, and then you'd have to do an annual assessment for farmers averaging, from a cash flow basis, you may well have paid a lot more tax up front than you necessarily have needed to. So how that will operate, again, we are going to be led by what the revenues decide to do.
On the flip side to that, though, however, I have had some clients that perhaps wouldn't have been open to using digital software before until these changes, and now that they've used it, got used to it, and can see the benefits, they are more than happy that they've done it. It's just going out of their comfort zone, really.
I think the digital software piece is another podcast you might want to have done, isn't it?
It is indeed a 2-part special. So yeah, look out for that
Oh.
one. So we alluded it earlier on, but do farms or can farms have 2 separate entities operating side by side?
It's more common than people would think. So often we see with clients that a number of them will actually operate a partnership and a company alongside one another, and this is where it tends to be the partnership itself is the farming entity and has the land, has all the crop sales, has all the inputs and a lot of the cost. However, it also has a company that sits alongside it, which in effect is a contracting company. So the contracting company will do all the work for the partnership, own all the fixed assets in terms of plant and machinery, and it will also house the labour. So it kind of almost is a way of differentiating between and de-risking, I should say, also between the doing and sort of the owning almost and the operation. This is because you've got a unlimited liability partnership as a general partnership that owns the land, does all the buying and selling and has all that sort of cost, and then you've also got a company that sits there with the plant and machinery and staff, all the main actual day-to-day operations sit within the company. So actually, the company itself as a limited liability entity has that protection for the family members, and they can work alongside one another. And it's also people think about it that there's making sure that you've got to have the right balance for what the contracting fee is, whether there's divisible surplus payable. It all needs to be as above board as possible to keep it in line with the regulations and the expectation from a tax perspective. But it's often ways of making sure that both elements also need to make money, and both businesses need to be commercial. But it's almost sometimes we have an issue where we've got too much cash in the company and then not enough in the partnership, and it's seeing how does that work in practice, and is it right? But it does allow you to have a differential in your partnership structure. If you've come across it a few times, I suspect, where you've got a non-individual partner, have you?
I have one client that has that, yeah.
So this is effectively where is it a trust
It is
as a partner?
Yeah, it's actually they have 4 trusts as a partner and then 1 normal partner. Well, a human
So
partner.
a normal partner
Yeah.
is an individual. So this is where you've got your normal partner is a human, a normal individual, and then a non-individual would be effectively a trust or a company. So this then allows you to have other. Again, it comes back to the makeup of the structure and the asset ownership, and partly tax planning and succession planning. That trusts are going to a part of that matrix in effect of succession planning. So if you've got a trust as a partner, it's a non-individual, it has a non-individual member, that has knock-on implications to how the tax regime works. So yes, the trust is still taxed as if it's a partner, so you then have the rates applicable to trust subject to how the trust is set up and when it was set up and what it was set up for. Whereby in a normal scenario you have a partnership of just individuals, the partnership itself would have has the £1 million of capital allowances, of which very useful from a tax planning perspective. Whereas if your partnership with a non-individual, i.e. a trust, that £1 million annual investment allowance isn't available to you, and you're only allowed the writing down allowances at 18%. So if you've got a partnership with a non-individual member and a company that does all the contracting, it actually allows you to do all your reinvestment in the company and gain all the capital allowances that you're allowed to and are eligible for without impacting the actual operation of the farming business itself. So it can be quite attractive to our clients to have that contracting element split out. Also allows you to go do contracting for a neighbour if you need to, or if it's an option.
So for mine, we set it up that way. It was for future planning because they were going to sell some development land. So again, that was quite attractive for them for tax purposes. But it was having those conversations with the clients and looking at what they wanted to do and how we could do it before they sort of put those plans in place. Was really key
That's
for us
key.
to be able to do that. Yeah.
It's key when it comes to the future planning and succession of a business that if you're looking to change the dynamic of the operation of the people or anything in terms of structural as well as within the tax planning, that having early conversations with us, your accountant tax advisor, and your solicitor, and often being around the table all at the same time can be really beneficial, because if you want to change something, you've got someone who can give you the legal perspective and someone who can give you the tax perspective. And I think that is essential when it comes to good planning.
And this is something I'm certainly seeing more and more as well now. And I think clients are understanding the cost benefit of having your accountants and other advisors together rather than separate or only speaking to one.
Yeah, so it's key when it comes back to a change in the business structure or business dynamic or whatever it may be within the family, that it has to be documented. And this is where partnership agreements or shareholders agreements are key. And that goes back to the point that we mentioned just before, was having different advisors in different specialities around the table can be a real benefit. So you can actually get a lot of progress and action points cleared, to basically move things forward. And as we talked about earlier, partnership agreement can be fairly malleable. It can be adjusted, and can be tweaked to what is the best outcome for the family. And I think they are there realistically as a default, because usually a family will make a decision as a collective. It's only really if there's a fallout that you then roll back to the partnership agreement, in my experience.
I have
And
some
you're
clients that
nodding.
don't even know they've got one, or then they check, oh, yeah, we do, for that reason, because they're making those decisions as families.
Yeah, and this is where a partnership agreement itself, often we've got clients who the latest version of the partnership agreement is in the 80s or the 90s. So actually, there's been various addendums or admissions or retirements or deaths or whatever it may be, that actually you still need to have an updated version. If it's that old, we've got to consider a potential renewal that comes through, and bringing it up to modern day law and regulations and expectations. Because often and it comes back to the point, if you don't have a partnership agreement, you roll back to the Partnership Act of 1890, which is very archaic, and splits it evenly. So if it's two partners, it's 50-50, three partners, a third each, and so on and so forth.
Even if it's not equal in the accounts.
Even if it's not equal in the accounts. And that's where people they sort of scupper themselves. And obviously I mentioned shareholders agreements as well. That is in effect a partnership agreement for a company, which that again is there as a default to position for decision making, for operation, for how succession may take place, where shares can or can't go, and who might have first right of refusal. There's multiple different options, but a shareholders agreement is there for the shareholders to fall back on, and to help deliver what decisions are made at particular points. So, and the benefit of a shareholders agreement sometimes means that you can change how it works with certain decisions that, from a company, there's certain decisions that require different levels of resolution, that ultimately you can then adjust that through a shareholders agreement if need be.
And I assume that, as the business progresses and things change, and perhaps partners in the partnership or shareholders, if responsibilities change and responsibilities change and people step up, they can be altered as they go along as well. So it's not always set in stone. It can be varied as time goes on.
It can be varied as time goes on, and what's particularly key within a partnership agreement, I say, is how the land and property capital is defined and allocated. That we tend to see that people think items are on the partnership balance sheet, but they're not. Items are registered, but they're not, and other things, that actually having an updated partnership agreement that has clearly defined land and property capital, that then can align from our side of things with how it's disclosed in the accounts, the value that's included in the accounts, and how it all comes together, that ultimately that is a real benefit. Because when it comes to the meetings that we hold with clients, they're not scrabbling around trying to find the partnership agreement that's tucked away in a back drawer. Often the accounts are much easier to pick up, and we turn to one of the back pages, and there's all the property capital aligned and who owns what. Because again, as you well know, sometimes we will ask the question, who owns that piece of land? They'll say, Dad will go, I do. And then we speak to the lawyer, and they say, no, he doesn't.
Yeah, or I've had that when they've decided to sell for whatever reason, and then obviously put the CGT to look at, and they have no idea, and then it becomes a bit of a nightmare.
Yeah, exactly. So having your records up to date is really, really beneficial generally, but also when it comes to particular transactions.
I think you mentioned it a little while ago, but flexibility in structures will be quite important for some of our clients. Do any of these structures allow for greater flexibility in terms of succession planning?
I think when it comes to succession planning, the changes in the budget October last year would mean that actually, from a flexibility perspective, owning a company can be a better way of obtaining a devaluation approach to shares. So, from an IHT perspective, a husband and wife are looked at as what they own together. So, in that previous scenario, if mum and dad own 60%, we value 60% of the company and then cut it in half for each of their respective estates. Whereas if it's sort of spread over a number of family members, obviously husband and wife could have less than 50%. But actually, the saying I refer back to is the sum of the whole. So if you valued the 100% of the share capital, doesn't equal the sum of the parts, because the parts themselves will have discount factors applied. Whereas in a partnership, it will be dependent on effectively an individual owns legally and beneficially their land capital, property capital. So that is wholly theirs. So that's valued at market value on their particular date of death, as it happens. They're also then entitled to X percentage as defined by the partnership agreement for what is their worth within the working capital of the partnership with the partnership balance sheet. So from that side of things, there's more value that's attributed to individuals within a partnership structure, but there's more flexibility in the day-to-day operation of the partnership compared to a company. There's a lot more regulation with the company, what you can and can't do. With the partnership itself, it's a bit more malleable as to how you can operate, how you can own things, how you can share them between the two of you, or three of you, or four of you, beneficially. So there's more flexibility with the partnership, but there can be other decent benefits that come with a company. It's weighing up the options as to what is going to be the right fit for the right family at the right time, and how they want to operate.
Yeah, and what works for one family doesn't mean that's going to work for another either.
No, you might have exactly the same business that owns a bit of arable land, does a bit of contract work, and has 4 family members. 2 businesses exactly the same, and you can guarantee that one structure works for one and doesn't work for the other. It's not a carbon copy. It never is.
And I know I've said it already, but this is so important why we're having these conversations with clients to figure out what is important for them.
Exactly, and sometimes it's weighing up the family dynamic versus the commercial dynamic and how they interlink with one another, because it needs to work for both the family and commercially, because if it doesn't work commercially, then there's probably a more difficult decision to be made at that point in time. So trying to work out what fits best and how it operates and who's going to be responsible for what areas or different diversifications or different parts of the business will be useful to have that discussion and get it agreed upon.
And I think I'm pretty safe in saying this, but I've been having a lot of conversation with clients about inheritance tax. I'm sure it is the same for you and probably most of us. So do any of these structures give, again, more flexibility in terms of an inheritance tax point of view?
From both perspectives, a partnership in a company or sole tradership, or again the variety that we've discussed, in essence, from an IHT perspective and the business property relief, agricultural property relief, the BPR, APR, both types of business, as long as they hit the necessary qualifying criteria, get the same relief. And so it just depends on the valuation that is applied within, whether it's shares or whether it's land or however it may be, that ultimately, as long as you hit the qualification criteria, that you would get BPR on your value in the partnership, but you'd also get BPR on your shares. Ultimately, it comes back to what I said before, that there is a potential option for devaluation from a company perspective if you have multiple shareholders. Devaluation isn't always the right answer, because you may end up with ownership coming too widespread that no decision can then be made in the future.
So again, another complicated area.
Yeah,
This is
correct.
what we're here for, though.
It's never easy.
No,
It's never easy.
Okay, so other than tax and flexibility, what other influences are behind picking a certain type of structure?
I think it comes back to the main one is family dynamic, because it has to work for the family. And if it doesn't work for the family, all the other elements are almost irrelevant. The other elements you then tend to look at is family dynamic, the goals of the family, so that is the family requirement. What is the risk and how they want to operate, and what are the legal requirements? There's many others that you would then consider, but I think when you're looking at from a liability perspective, and what you then have to do on the reporting front, I think that's what you then tend to look at from what structure might be beneficial, but also what is your aim of what if you want to change structure, why do you want to do it? What's your end goal? And then we work away as to what is going to be beneficial for you and the family.
So it's working backwards and to figure out, well, if you know what you want and how we can get there.
That is the golden goose question, because if you've got to know what the end goal is in order for us to then piece our way through there.
So what advice would you give to anyone that's just starting up and thinking about structuring their business?
Ultimately, with any new farming business or rural business, whatever it may be, you need to have a discussion with an accountant and tax advisor to understand the options that are available in the first place. It tends to be that individuals will set up a business as a sole trader or a company, and they don't necessarily think, I shouldn't have set up as a company. I should have gone into partnership with my wife or my husband or my son or my daughter or whatever it may be. That actually that would have been a better option for them. And then once it got off the ground, you would then have potential to incorporate, because there are additional costs and reporting requirements with the company compared to a partnership. But I think there's more stringent statutory requirements.
And on the flip side of that, and I think we did mention this too, that businesses do develop and change over the years go on. If they were looking at a potential restructure due to income changes or personnel changes, what would your advice be to those?
So the income and personnel change, in terms of when it comes to personnel changes, if you're a company, people can step away. If you're a shareholder and you've been an active director, you can step away from the business but still be a shareholder, and you can then replace yourself with outside work, or you might put your farm out to contract from that side. So you can still step away from the business and be an owner and be an active owner. Whereas when it comes to a partnership, from a succession piece, people might wish to step away, at which point there are other tax implications to consider. Whether you're an active farmer or not an active farmer, that is quite a key definitive point when it comes to the relevant reliefs. That ultimately there's two ways to go about it. There's positive and negatives of both options in realistic sense. And when it comes to the partnership, it can be harder to still remain an active farmer if you step away completely, but people will do that, and they step back, but they still try to remain an active partner. But within a partnership itself, you can admit and retire partners as necessary. Obviously, it's the individual partner's decision if they wish to retire, and it's a unanimous decision for all partners if they want to introduce a new one. Or that often is the case, subject to how, again, it comes back to how the partnership agreement's written as to whether what requires what decision. And you can pass assets reasonably freely, subject to them qualifying for holdover relief within a partnership. Whereas passing shares, it tends to be similar for a company, albeit there are certain restrictions to holdover relief if you have non-trading chargeable assets in a company. So that's always another thing to consider when you're trying to move shares between generations, and that's where you need to take advice and don't do it off a whim.
I think you've covered this, but there are a lot of different elements just to making one simple decision.
Correct. And it's thinking about them in the round as well as the tax consequences. But ultimately, it comes down to every family business. Don't let the tax tail wag the commercial dog.
I definitely think there's been a shift in that approach too, especially with the changes. There's a lot more going on now. I think people are aware of that.
People are keen to move things on, keen to bring the next generation through quicker than had previously been discussed. So it's a good thing in the round. As you say, that most landowners are between 60 and 90 statistically, and I think roughly the average age of the farm, I think is now 62. I might be wrong on that, but I think it is low 60s, the average age of a farmer. So we need more young blood to come into the industry as a whole.
And I think the role of any advisor, accountants, solicitors, or whoever, it's important that you have them engaged. And like for me, seeing some of my clients who have passed me things on, I'm now dealing with the younger generation, so it's really key to have those conversations, not just with the family, but with us, so we can see what's happening and keep a track of it and advise.
And it's making sure that the next generation understand the expectations of being a partner or being a director or being a shareholder. They need to understand the requirements, but also the risk.
I think it's actually one of the favourite things of my job is actually seeing the sort of legacy being passed on. It's quite fascinating, and for me it's special to sort of have those clients, even though with those changes.
Yeah, people in farming tend to see themselves as custodians. I often have conversations with clients. They say, I don't actually own it. I'm just holding onto the asset till I can pass it on to my children. And that's the mentality of it. And so that's why the difficulty with the changes in the tax rules is a real concern for a lot of farming families.
And we've also covered that on another podcast as well. You'll be pleased to hear, which was a long one.
There you go.
So we've talked about changes and bringing people in, but what about exit strategies? What if people wanted to exit a family business? How does different structures impact this?
So let's start with a partnership. So a partnership, again, comes back to what the partnership agreement states as to what an outgoing partner has a requirement to do. They would have to obviously give notice to the other partners that they intend to retire or tend to exit from the partnership. The partnership itself will define as to how that operates with regards to whether a balance sheet revaluation is required or not, and whether the individual partners themselves can effectively take their value of their current account, which will be paid out usually in instalments between, I've seen some have got to be paid out within 2 years, others that have to pay out across 10 years. And then there is often, again, it comes back to having an up-to-date partnership agreement, is that if you have land capital within the business, there is the option that you can take that out as part of your payment in specie. But often it is written in there that the continuing partners will have the option to write to the exiting or retiring partner within 3 months of their retirement notice to notify them that they will be buying out their land capital, and that tends to always happen at market value. So that would be how they would exit from a partnership generally, but it will be dependent on what is written in the partnership agreement and whether you have one or not. So with a company, you've got two options when it comes to an exit. As a shareholder, you own the shares themselves. So as an individual, you will be likely selling those shares to the other shareholders of the company. So they would individually have to buy you out, thereby increasing their shareholding. Whereas there is the alternative that you can go out to third parties and try and sell your shares to them, but ultimately you are unlikely to receive the same amount that you would get if you were to sell to the other shareholders. The other option is the company buying them out. So company, as long as you hit the relevant qualifying criteria, you can do what's called a purchase of own shares, a POS, which is also known as in the game as POOS.
Oh, how lovely!
Which tends to get a bad rap for the nickname of it. However, it is a useful tool for companies to buy shares back from its shareholders. Again, have got to meet the necessary criteria, and if you are looking at that, you need to then contact your advisors to discuss that. But ultimately, it allows the company itself to raise funds to buy the shares off the exiting shareholder. When it comes to a company exit, generally, if you've got a shareholders agreement in place, that will define as to how you are going to operate, as to how it has to go through in the step process. That are you allowed to go? You have to effectively offer your shares to the other shareholders, or offer them to the company, or you then potentially have to give them away to your children. And then usually the last ditch attempt is that you then have to offer it to a third party. Often that is not always the best option within the family dynamic of if you offered shares to a third party, but you're likely to get a heavily discounted value if you were doing that, subject to how many shares that you own.
So arguably, this also needs to be considered when thinking about these structures, as it's quite different as well.
Yes, and the exit point as well, from a company itself and similar from a partnership, there are the options as long as you hit the criteria for what's now known as business asset disposal relief, formerly entrepreneurs relief, that you can obviously pay the first £1 million at a slightly lower capital gains tax rate, £1 million of gains that is, at a lower capital gains tax rate, which as at we sit today, that it would be taxed at 14%. But as of April next year, it will be going up to 18%, and it previously was 10%. So it's getting not as attractive as it used to be.
Well, talking of exiting, I think that would be a good note for us to finish on. So thank you very much, Laurie, for joining. There's some really useful insights there.
Thank you for having me, Laura. It's been great fun.
If any of our listeners have any questions or queries, then please do not hesitate to get in touch. Our contact information will be in the show notes.
Thank you for joining us for Larkin Gowan Insights, Accountancy and Business Advice for All. Don't forget, you can find more information about today's topic and more about how our team of experts can help you in your business by visiting our website, larking-gowan.co.uk. Join us again next time for another fascinating insight into the world of accounting and finance.